Look, I need to talk to you about this whole retire early on dividend stock strategy, because what you're hearing from the financial media, from these Wall Street advisors, from all these fire movement gurus is dangerously incomplete. And frankly, it's setting people up for disaster. And the reason I'm so passionate about this is because I see millions of Americans putting their faith in a strategy that's built on a foundation of sand. Everyone is talking about dividend stocks like they're this magical passive income machine. Like you just buy some shares of blue chip companies and boom, you're collecting checks for life and you can retire at 45 or 50 and live off these dividend payments. The financial industry is telling you that if you just accumulate enough dividend paying stocks, you'll have this snowball effect where your dividends buy more shares, which pay more dividends, and it just compounds forever into financial freedom. And I'm sitting here watching this unfold thinking, how is it possible that people can't see what's right in front of their faces, which is that they're measuring everything in dollars, in pieces of paper that are being systematically devalued by the Federal Reserve. And when this house of cards finally collapses, everyone is going to act surprised, but they shouldn't be surprised because the warning signs are everywhere. Here's what's really going on that nobody wants to talk about. These dividend strategies look amazing when you backtest them through decades of falling interest rates and massive monetary expansion. Of course, dividend stocks performed well from 980 to 2020. We had a 40-year bull market in bonds. Interest rates went from 20% down to zero, and the Fed inflated every asset price on earth. But that era is over. We're not going back to those conditions. The Fed has painted themselves into a corner where they can't keep rates at zero without destroying the currency completely, but they also can't raise them to anywhere near where they should be without imploding the entire debt-based economy. So what's going to happen? They're going to choose inflation. They're going to print. They're going to destroy the purchasing power of the dollar because that's the only politically acceptable way out of this debt trap we're in. And here's the thing about dividend stocks that these early retirement people don't understand. You're not really getting paid in anything real. You're getting paid in depreciating currency. Let's say you build up a portfolio that pays you $50,000 a year in dividends. Sounds great, right? You can live on that, retire early, enjoy your life. But what happens when inflation is running at 7, 8, 10% a year? What happens when the real inflation rate, not the manipulated CPI nonsense the government puts out, but the actual cost of living increase is 12 or 15% annually? Your $50,000 in dividend income is losing purchasing power every single year. The number of dollars might stay the same or even grow slightly, but what those dollars can buy is shrinking rapidly. Now, the dividend growth advocates will say, wait a minute, Peter, these companies raise their dividends every year. That's the whole point of dividend growth investing. You're getting an inflation hedge built right in. And to that, I say you're living in a fantasy land. First of all, dividend growth has historically lagged real inflation by a wide margin. When you have genuine high inflation episodes, corporate profits get squeezed, input costs skyrocket, and guess what? Gets cut. Dividends. We saw this in the 1970s. We saw it in 2008 and 2009 when supposedly rock-solid dividend aristocrats slashed or eliminated their dividends entirely. GE was supposed to be the ultimate dividend stock. What happened there? Banks were paying huge dividends right up until they weren't. When the crisis comes, and it is coming, these dividend payments you're counting on to fund your retirement are going to disappear or become worthless in real terms. But here's the even bigger problem with this whole dividend stock retirement strategy. It's based on valuation levels that are completely divorced from reality. Look at where stock prices are today relative to earnings, relative to book value, relative to GDP, relative to any historical metric that matters. We are at or near all-time highs by almost every measure. The Buffett indicator, market cap to GDP, is flashing bright red that stocks are wildly overvalued. Price-to-earnings ratios are in bubble territory. And why? Because the Federal Reserve has forced everyone into risk assets by keeping interest rates artificially suppressed for over a decade. When you can't earn anything in a savings account, when bonds pay negative real yields, people desperately reach for yield in stocks. This has pushed dividend stocks in particular to absurd valuations because everyone wants that income. So what you've got is people buying dividend stocks at the absolute peak of a valuation bubble, thinking they're being conservative and safe. Because, hey, these are established companies that pay dividends, not some speculative tech stocks, but they're paying 30 times earnings for these companies. They're buying utility stocks and REITs and consumer staples at prices that offer dividend yields of 2 or 3% when inflation is running much higher than that. You're locking in a negative real return from day one. This is insanity. The whole strategy depends on prices staying elevated or going higher. But we're already at extremes. When the reversion to the mean comes, and it always comes, these portfolios are going to get destroyed. And let's talk about what dividend stocks actually are in many cases today. A huge portion of dividend payers are companies that are not really growing anymore. Mature companies, legacy businesses, often in declining industries. They're paying out dividends because they don't have better uses for that capital. They can't find growth opportunities. So they're returning cash to shareholders. Fine. Nothing wrong with that in principle. But in an inflationary environment, what you need are companies that can raise prices, that have pricing power, that can grow their revenues and earnings faster than inflation. A lot of these dividend stocks are in precisely the wrong sectors for an inflationary crisis. They're in regulated industries where they can't raise prices easily, or they're in competitive businesses with thin margins that get crushed when input costs spike. Even worse, many companies today are paying dividends they can't actually afford. They're borrowing money to pay dividends. They're paying out more than they earn. Look at the payout ratios. Look at how many companies have been buying back stock and paying dividends funded by corporate debt. This worked great when they could borrow at 2 or 3%, but those days are over. When their debt rolls over at 7 or 8 or 10% interest rates, the math completely breaks down. These dividend payments are not sustainable. They're built on the same cheap money foundation that's crumbling underneath the entire economy. Now, here's what really gets me about this retire early on dividends idea. The people promoting this are using back-tested data and assumptions that have no basis in the current reality. They'll show you these beautiful charts showing how if you'd invested in dividend aristocrats over the past 30 years, you'd be rich and retired by now. Well, of course, you had falling interest rates pumping up all asset values. You had globalization and cheap Chinese manufacturing keeping inflation low. You had a relatively stable dollar with no serious competitors. You had the U.S. as the unquestioned hegemon with the reserve currency. None of those conditions exist going forward. The world has fundamentally changed. Interest rates have nowhere to go but up from these artificially suppressed levels. Globalization is reversing. Supply chains are breaking down. Geopolitical stability is deteriorating. The dollar's dominance is being challenged by China, Russia, and even our supposed allies who are quietly diversifying their reserves. And the Fed, the Federal Reserve, these people have no idea what they're doing. They spent over a decade telling us inflation was too low, that they wanted more inflation, that they couldn't hit their 2% target. They printed trillions of dollars They bought bonds, mortgages. They expanded their balance sheet to $9 trillion. And then when inflation finally showed up, what did they say? Transitory. It's temporary. Supply chain issues, don't worry about it. They were completely wrong. Inflation wasn't transitory. It was inevitable result of their money printing. And now they're trapped because if they try to fight inflation seriously by raising rates to where they should be, 10 or 12 or 15%, they'll crash the economy. They'll bankrupt the government, which can't afford to pay high interest on $35 trillion in debt. They'll destroy the stock and bond and real estate markets. So they won't do it. They'll do the bare minimum to pretend they're fighting inflation while actually letting it run hot to erode the real value of all this debt. What does this mean for your dividend retirement plan? It means the dollars you're collecting are going to buy less and less every year. It means the companies you own are going to struggle in this environment. It means the valuations you paid are going to come crashing down when we have the inevitable recession or crisis. And yes, we will have a crisis. The amount of debt in this system, government debt, corporate debt, consumer debt, is unprecedented. It's mathematically impossible to pay it back. The only way out is inflation default or some combination of the two. And when that happens, your dividend income is going to evaporate or become worthless. Look, I've been warning about this stuff for years. I warned about the housing bubble before 2008 when everyone said housing prices never go down. I warned about the tech bubble in 2000. I've been warning about the everything bubble we're in now, and I get mocked. I get called Dr. Doom. I get told I'm always predicting crashes. But here's the thing, I'm right. The crashes happen. The bubbles pop. The difference is I understand Austrian economics. I understand that when you create money out of thin air and hold interest rates below the market rate, you create malinvestment, you create bubbles, you create unsustainable booms that must end in busts. This is not pessimism. This is just economics. The hangover is coming. It's just a question of when and how severe. So what should you do instead of this dividend stock retirement fantasy? First, understand that you need to preserve purchasing power, not accumulate paper assets denominated in depreciating currency. That means real assets, gold, silver. These are real money. They've been money for thousands of years. You can't print gold. You can't create it with a computer keystroke. It has intrinsic value. It's nobody else's liability. When you own physical gold, you own something real. When you own stocks, you own a claim on future cash flows denominated in dollars that are being debased. When you own bonds, you own certificates of confiscation, as I like to call them. You're guaranteed to lose purchasing power. But gold maintains its value over time. An ounce of gold bought roughly the same amount of goods 100 years ago as it does today. Can you say that about dollars? Now, people will say, Peter, gold doesn't pay a dividend. It just sits there. And to that I say, exactly. That's the point. Gold is savings. It's storing your wealth in something that can't be debased by central bankers. The lack of yield is actually a feature, not a bug, because it means it's not dependent on the health of some corporation or the promises of some government. And by the way, in real terms, gold has massively outperformed stocks over the past 25 years when you adjust for actual inflation. The Dow is roughly where it was in 1999 when priced in gold. All those gains. Illusory. Just dollar depreciation. Second, if you're going to own stocks, understand what you're doing. You're speculating, not saving. There's nothing wrong with speculation if you know that's what you're doing and you can afford to lose But don't fool yourself into thinking a portfolio of dividend stocks at current valuations is a safe retirement plan. It's not. You're buying at the top of a bubble. You're exposed to dollar depreciation. You're exposed to dividend cuts. You're exposed to valuation compression. Maybe some of these companies will survive and even thrive, but you're taking massive risk, whether you realize it or not. Third, diversify outside the dollar and outside the United States. The U.S. economy is living on borrowed time and borrowed money. We don't produce enough to support our consumption. We run massive trade deficits year after year. We import goods and export dollars and IOUs. This works only as long as foreigners are willing to accept our currency and our debt. But that's changing. China is our biggest creditor, and they're our strategic rival. Does anyone seriously believe they're going to keep financing American consumption forever? They're already diversifying their reserves, buying gold, making deals in yuan, building alternative payment systems. The petrodollar system that supported American hegemony for 50 years is breaking down. Saudi Arabia is selling oil to China for yuan. Russia is demanding payment for gas in rubles. The world is slowly but surely moving away from dollar dependence. When that happens, when the dollar loses its reserve currency status, the American standard of living is going to fall dramatically. We've been living beyond our means for decades, consuming more than we produce, because we could print the world's reserve currency and exchange it for real goods from abroad. That party is ending. And when it ends, the idea that you're going to retire early and maintain your lifestyle on dividend checks is laughable. The adjustments that are coming are going to be severe. Fourth, have realistic expectations. I know people don't want to hear this, but the era of easy wealth accumulation is over. The 40-year tailwind of falling rates, rising asset prices, dollar hegemony, that's done. Going forward is going to be much harder. You're probably going to have to work longer than you want. You're probably going to have to save more and consume less. The lifestyle people have become accustomed to, financed by debt and currency debasement, is not sustainable. The bill is coming due. The longer we pretend otherwise, the worse the eventual reckoning will be. Fifth, be extremely skeptical of anyone selling you a get rich, quick, or retire early scheme. These financial influencers pushing dividend portfolios and 4% withdrawal rates and passive income fantasies, they're either ignorant of basic economics or they're selling you something, usually both. They make money from ads, from affiliate links to brokerages, from selling courses and books. They have an incentive to tell you what you want to hear, which is that you can retire early and live off investments without taking real risk. But it's not true. In a sound money system with positive real interest rates, maybe you could safely live off conservative dividend income. But we don't have that. We have a currency that's being systematically destroyed and an economy built on debt and speculation. The reality that nobody wants to talk about is that most people are not going to be able to retire early. Most people are going to have to work well into their 60s and 70s, not because they want to, but because the purchasing power of their savings and pensions and Social Security is going to be inflated away. Social Security is already mathematically bankrupt. The promises made cannot be kept at anywhere near current benefit levels in real terms. They'll pay the nominal amounts because they can print money, but what those payments can actually buy is going to be far less than people are expecting. The same thing is going to happen to private pensions, to 401ks, to dividend portfolios. The nominal numbers might look okay, but the purchasing power is going to evaporate. I know this is not what people want to hear. Everyone wants to believe they can work for 20 years, accumulate some dividend stocks, and then coast for 40 years on passive income while prices stay reasonable and everything works out fine. But that's not how economics works. That's not how history works. Every fiat currency eventually fails. Every debt bubble eventually pops. Every period of artificial prosperity built on money printing eventually ends in crisis. We're not different. We're not special. The laws of economics apply to us just like they applied to Weimar Germany, to Zimbabwe, to Venezuela, to every empire and currency that came before. The emperor has no clothes. The Federal Reserve has no idea what they're doing. They're making it up as they go along, desperately trying to keep this debt-fueled charade going for just a little bit longer. But they can't repeal economic reality forever. At some point, the music stops. At some point, the market reasserts itself. At some point, the accumulated imbalances and malinvestments have to be cleared out. That process is going to be painful. That process is going to destroy a lot of nominal wealth. People who think they're set for early retirement are going to find out they're not. So what's my advice? Protect yourself. Own real assets, primarily gold and silver. Reduce your exposure to dollar-denominated paper assets, especially at current valuations. Don't count on dividend income to fund your retirement because that income is paid in currency that's being debased and those dividends can be cut. Work longer, save more, consume less. Get your expectations in line with reality. Understand that we're in the late stages of a debt supercycle, and the end game is not going to be pleasant. The people who recognize this and prepare accordingly will weather the storm. The people who keep believing in the fantasy of easy retirement funded by passive dividend income are going to be devastated when reality hits. I've been warning about this for years, and I'll keep warning about it, even though most people don't want to hear it, because I'd rather be right than popular. The math doesn't lie. The history doesn't lie. Fiat currencies fail. Debt bubbles pop. Central bank manipulation creates distortions that eventually have to correct. This ends badly. There's no soft landing when you're this deep in debt with a currency this debased and assets this overvalued. The Fed is going to print until the dollar is worthless because the alternative is admitting their policies failed and allowing a massive deflationary depression. They'll choose inflation every time. Your dividend stocks aren't going to save you. The snowball effect you're counting on is going to melt when the real inflation heat gets turned up. Those reliable dividend payments are going to shrink in purchasing power or disappear entirely when the crisis comes. The valuations you paid are going to compress brutally when we get realistic interest rates, or even just when the next recession hits. This is not the path to early retirement. This is the path to disappointment and financial hardship. Protect yourself with real money. Understand the times we're living in. Don't believe the Wall Street sales pitch or the Federal Reserve propaganda or the Fire a Movement hype. Believe in economic fundamentals. Believe in thousands of years of monetary history. Believe in the fact that you can't print your way to prosperity and you can't borrow your way to wealth, and eventually the piper must be paid. That day is coming sooner than most people think, and when it arrives, those dividend retirement dreams are going to turn into nightmares.